Hello. As I informed, I am going to handle the unit 3, 4, 5 and 6. So first of all, before going for unit 3, in unit 1, we are going to study how the money is involved in international trade. So you maybe know about the barter system, then after bimetallism where two metals, gold and silver is used as a mode of exchange. Then after the classical gold standard where the silver is removed as a mode of exchange and the gold only is treated as a mode of exchange. Then after interwar period is there where the international trade is almost stopped and there was a difficulty in reintroduction of the classical gold standard and there was a financial crisis in this interwar period because of the dominance of those countries which is having a more gold reserves. The Bretton Woods system is came into existence, and here also on the basis of the price of the gold the exchange rate is fixed, and major currency which will help to decide the exchange rate is the dollar here. And then after, because of the dominance of the US dollar, the Bretton Woods commission system what is there, so that particular system is removed and now we are using the flexible exchange rate where our currency exchange rates are decided by demand and supply factors. So this is how the money is evolved in the international trade. And then after, in unit 2 we are going to study how these transactions are settled in a different currencies. Okay, so that is regarding the balance of payment, where balance of payment is like the profit and loss account where we are going to mention the payables and receivables too. Okay, so there are two accounts, current account and a capital account. Current account is for the short term transactions, capital account is for the long term transactions, and the official settlement account is there. There is an adjustment account. So those all things are also there, and at the end we are going to identify surplus or deficit. So is it a favorable condition for the country or the unfavorable condition for the country? So regarding the settlement we are going to study under the unit 2, and now under unit 3, that is international financial market, we are going to speak about the investment. So what about the investment in international markets? That's it. You know about the financial market, right? So now what about the international market? We will speak little bit. So in investment analysis, there is a two steps. One is the fundamental analysis, the second one is the technical analysis. Under fundamental analysis we are going for the economy analysis. It is also called as a market analysis. What this particular analysis says, we should analyze the economy properly, whether we are going to invest in the economy of India, whether we are going to invest in the economy of US, whether we are going to invest in the economy of European Unions, whether we are going to invest in the Russia, China or any of the countries' economy. So what is the condition of that? What may be the future fluctuations, or in which economy how much we should invest? So this is what comes under the investment analysis in the international level, and the same thing we are going to study under this particular unit. So before going for the investment aspects, let's understand what is financial systems, classifications, structures and all. See, this is the classifications or the structure of the financial system in every country. Usually this will be the structure. So there will be a money markets, and even there will be a capital market. Money market is for the short term and the capital market is for the long run. Okay, so regarding the money market we are going to study in coming units, so that's why I am not going to touch the money market here. I am going to speak about the capital market. So here is organized capital market and unorganized capital market. So what about organized capital market? It is a controlled market. Okay, so standardized, statutory controlled organization is there, and unorganized, it is not properly organized. So some of the lenders like local lenders, money lenders and all, right? So under organized market, stock market is there, loans from the banks and NBFCs also there. Okay, So under the stock market, we have the government bonds and the corporate securities. Few public companies may sell their equities. Government will not sell the equities in their name, but government can sell the bonds. Okay, it's called as the gilt-edged funds. They can sell the bonds in their name. Okay, the corporates can sell both equities and the bonds. Okay, the private companies, even the public companies. Okay, so what's the difference between private companies and the public companies? Private companies are the companies where the funds or the ownership is held by the private people. Okay, so it may be owned by one particular person. So as per the rule, it is more than a 40%. If any one person is having or any group is having more than a 40% shares or the ownership, then it is called as the private company. If it is owned by the public, it is raised the public funds, then it is called as a public company. Okay, remember, government companies and the public companies are not same. This is regarding the financial markets classification or the financial structure. So now we'll understand the capital market. So these all things you are already studied, but I'm speaking about a little bit updated versions of domestic financial management. So a capital market is a segment of the financial market that dealing with the effective channeling of the medium to long-term funds from the surplus to deposit units. So the main feature here is from the surplus, those who are willing to invest, from them to the deposit, those who needs the money, they are going to adjust or they are going to channel or they are going to supply the funds. Okay, so that particular market is called as a capital market. Normally the process of transfer, this channeling is through the documents or the certificates, and nowadays this is completely dematerialized, thus is showing the evidence of the investment. So in your demat account you will find your stock certificate or the share certificate. So role of the capital market here. Here the primary role, raise the long-term funds for the government, banks and the corporations. Fund is regulated by the performance of stocks and bonds market within the capital market. Okay. Then mobilization of saving. You might be studied the over investment or the over savings theory. If in one particular economy, if the savings is become more and more, then obviously the supply of the money will be decreased and it may lead to hyperinflation situation, right? So to avoid that one, we can invest in some of the stock. It is a mode of saving too, and it is a mode of investment too. Speed of the economic growth, because of the investment, the economic growth will be increased. The continuous availability of funds, the funds are continuously available in the capital markets. Okay, the proper regulation of the funds. Okay, the funds are properly regulated because the capital market is regulated by the statutory authority of that particular country. For example, US means obviously US regulatory authority is there. In India, SEBI is the regulatory authority. So for the particular country, there will be a regulatory authority for the capital market. Every capital market in this world is regulated by the financial regulators and their respective government bonds. And as you know, the capital markets is regulated by the financial regulators. Here the financial regulators in an international level, also financial regulators are there. Okay, like IMF and IBRD, and in the domestic level also the financial regulators are there. For example, RBI. The purpose of such a regulation is to protect the investors from fraud and deceptions. Financial regulatory boards are also charged with minimizing the financial losses. So the capital market of India is handled in such a way that the losses for the investors will be very less or it is minimized. Okay, so here is the nature of the capital market. It deals with the long-term securities. Capital market helps in a capital formations. Capital market performs a trade-off function. Capital market helps in creating the liquidity also. Okay, so types of the capital market, you know about this: primary market and secondary market. Primary market is the new issue market. Either the company may be a newer one or the company may be a older one. It is for a new securities. Okay, primary market is for the new securities. The secondary market is for the old securities. Okay, pre-owned securities, we can say. So here is primary market. The primary market deals with the newly issued securities. Role of the primary market: it organizes, it underwrites, and the distribution is also there. You know about these all things. I am not going to explain each and everything. Primary market is only related to the new issues. Okay, it is related to the new issues. It has no particular place, obviously. The secondary market, it is also called as aftermarket. Okay, because after the IPO, initial public offering, once the shares are issued to the shareholders or the subscribers, then only this secondary market concept will come. Okay, before the primary market, the secondary market cannot be there. And it is a financial market in which previously issued financial instruments such as stocks, bonds, options are brought and sold. Okay, pre-owned securities are brought and sold. Here the main function of the securities are sold and transferred from one investor to another. Okay, so here the securities are sold and it is also transferred. The ownership is transferred, and it is important that the secondary market should be highly liquidated. Okay, so the liquidity of this secondary market should be more and more. Okay, so that's it for today's class. In coming classes we are going to speak about the capital market, instruments, and types of the capital instruments.